The average salary in Germany is about 50,000 euros a year. And with rising inflation, building wealth in Germany can seem like a far-fetched dream. I know not everyone watching this video has a high salary or a high savings rate, or even much left to save by the end of the month. And seeing those huge portfolios online can definitely be discouraging. Don't get discouraged. Let me share exactly how to build wealth in Germany, especially as a regular employee. By the way, if you're new to the channel, my name is Essen, and on this channel, I share how to succeed financially in Germany. Now let me start with the facts. There is no shortcut to building wealth in Germany, at least not one that is legal or doesn't rely on a 1 in a billion chance of luck. Like anything else, building wealth is a long and time-consuming process. But contrary to what some might say, it is possible to build wealth in Germany as a foreigner or an expat, if you do things the right way. Before I dive into the details, building wealth can have different meanings for every individual. For some, having a net worth of €500,000 would mean being wealthy. For others, it might be 2 or even more million euros in net wealth. No matter your definition of wealth, most people in the world start from little to no wealth. On top of that, most expats in Germany have small amounts of savings each month, but you can build up assets over the years. A good way to do this is a savings plan with low-cost stock index funds or ETFs. Before I share how a savings plan works, let me share who is a savings plan suitable for. A savings plan can be helpful in these situations. You want to grow your money but can only save a little each month. You want to save time by not buying stocks one by one and prefer to set up a plan that runs automatically, or you have a larger amount of money to invest but you would like to start with a savings plan to get comfortable with the stock market. How does a savings plan work? A savings plan lets you buy shares in an investment fund with a set amount of money you choose. Because as an employee in Germany, you may not have much to invest each month. But let's say, for example, if you put in 100 euros and each share costs 25 euros, you'll get 4 shares in your account. Since the price of the fund changes frequently, you may get full shares and also some small fractional shares. For example, if you invest 100 euros one month and the share costs 30 euros, you'll get the full 3 shares and a fractional of another one. In the next months, as the price goes up, you might get smaller fractions like 0.9 or 0.8 shares. Over time, these add up. After a few months, you might have more shares in total. If you sold them at a higher price in euros per share, you'd get a profit. If the price decreases and you sell at a lower price, you will make a loss. When selling, you might have to pay fees and taxes, depending on various conditions. There could also be small fees when buying. It's better to hold on to your shares for many years instead of selling right after a small price increase. The shares you get through a savings plan are the same as the ones you'd get if you bought them individually. If you ever want to invest more money, you can make a separate purchase to increase your holdings. What should you consider when creating a savings plan? If you want to build wealth over time, equity funds are important. I recommend exchange-traded index funds or ETFs instead of actively managed equity funds. ETFs are simple, low-cost, transparent, and easy to manage, making them great for long-term savings. ETFs track a stock index. When you invest in ETFs, you don't have to worry about whether the fund manager is making good or bad decisions because there isn't one. ETFs simply follow the performance of the stock index they are based on, minus a small management fee. Now, is an ETF savings plan a good idea? If you're patient, it can be beneficial. With an ETF savings plan, you regularly buy fund shares, and since stock prices can go up or down, the value of your ETF can also change. This means your savings plan might temporarily lose its value. That's why it's important to only invest the money in this plan that you don't need in the short term, at least in the next 7 or even better 10 years. Over time, past losses have usually been recovered. So patience is key when saving with ETFs and building wealth in Germany as an employee. Please hit the like button if you're getting value from this video and consider subscribing. In the past, those who stuck with their savings plan were often rewarded with good returns. For example, a savings plan in an ETF tracking the S&P 500 stock index has earned an average of 11.48% per year in the past 15 years. Adjusted for inflation and with reinvested dividends, the S&P 500 earned an average return of 10.69%. However, if someone started in July 2019 and stopped their plan after the pandemic in 2020, they would have lost money, almost 18% of their portfolio value. So let's do some calculations. Let's say you started back in 2010, each month investing €100 in the S&P 500 ETF. Let's consider the inflation-adjusted growth of 11.5 period over that time. Your invested amount of 18,000 euros would have grown to 42,902 euros, meaning a growth of over 200%. When to get started? You can start a savings plan for a stock index fund no matter what's happening in the stock market. The timing isn't important at the beginning because you're only investing a small amount of money. If prices go down at first, don't worry. With a savings plan, you can keep buying shares over a long time, so sometimes you'll pay more and sometimes less depending on the price changes. You will see many days when your stock portfolio is in green and some days where the value drops drastically. That's why the timing of when you sell is more important. Imagine you just found a €100 bill on the ground. You're super excited, right? That's like making a profit in the stock market. You see the value of your stock go up and it really feels good. But now imagine you put that €100 in your pocket and later you realize it's gone. You'd feel pretty upset. Maybe even more upset than you were happy when you first found the money. This feeling is what's called loss aversion. It's a psychological thing where losses feel way worse than gains feel good. In the stock market, if you see your stocks go up and you're €100 richer, that's exciting. But if those same stocks then drop, making you €100 poorer, the pain that you feel from losing that €100 is much stronger than the joy you felt from gaining it. So even though on paper you're back at the same point where you started, it still feels like a loss because your brain is wired to hate losing. This can lead to people making bad decisions in the stock market, like holding on to losing stocks for too long because they don't want to lock in the loss, or selling winning stocks too soon because they are afraid of losing their gains. So if the stock market drops just when you're ready to sell, it can hurt your returns. In that case, it might be better to hold on to your shares a little bit longer and wait for the prices to recover. Or you could sell earlier if you've already reached your savings goal. Another option is to move your money slowly into safer investments as you get closer to the end of your savings plan. This way you protect your profits. Which funds and ETFs make sense for a savings plan? There are a lot of funds and ETFs out there. Just have a look at the funds available on Scalable Capital. So many different options to choose from. When you are choosing one to invest in, you want to look for one that has low fees because each ETF charges what's called a management fee or the total expense ratio. It's a small fee taken in addition to your investment for giving you the convenience of owning all of these stocks in one easy purchase. This management fee, as I said, is an expense ratio. This expense ratio could be between 0.something% up to 2 to 3% and even higher. Anything below 0.5% is okay. But I recommend you staying away from ETFs that have a high expense ratio, higher than 1%. Ideally, an ETF with an expense ratio in the 0.0 something range would be perfect. Generally, funds or ETFs that follow a specific index have such a low expense ratio. These funds are also known as index funds. One of the most popular examples would be the S&P 500 ETF, which tracks the performance of the top 500 companies in the United States. There are other examples of index funds like Nasdaq, FTSE, or the MSCI World. These index funds have a very low expense ratio as these track specific indices compared to actively managed funds where specialist managers pick and choose specific stocks to invest in. As people are actively managing these funds, the expense ratio for them is quite high. Now, here you might think, why not choose a fund or ETF where the stocks are picked by professionals whose job it is to do so? However, research shows that index funds generally perform better than actively managed funds. How to start a savings plan in Germany? Alright, now that you know what a savings plan is and how to get started with building wealth in Germany as an employee, let me share exactly how you can start a savings plan. To get started, you will need to open an investment account. My favorite, as you already know, is Scalable Capital. It's a great investment account and the company is based in Germany, which means you do not need to worry about handling taxes. In this video, I share my step-by-step guide on how to use Scalable Capital and create a savings plan. And in this video, I share some of my favorite ETFs and how to start your first investment in Germany. So thanks for watching, bleib gesund, and I'll see you in either of these two videos.